Cost push inflation. By the end of this video, you should understand the impact that political actions on the minimum wage / living wage can have on consumers and the economy, and we'll focus on that term cost plus inflation. Okay, I want to start with a little bit of background about this video. Currently in the UK, we are starting to see the political parties battle it out for the chance to run the country for the next 5 years. Some politicians are talking about increasing the minimum wage / the living wage. Now, this may sound appealing at first. However, what would be the greater impact on the economy? Would we as consumers actually be better off with a greater living / minimum wage? Now, I want to make it clear that this is not going to talk about any political party or any way that you should vote, purely looking at what's being said and how it impacts on the economy. Let's take an example. Currently, bee is producing jars of honey, and each jar of honey sells for £5 each. £3 of that cost is actually labour costs. Now, meanwhile, in government, we've elected a new government, and they've decided to increase the living wage by 30%. Now, the politicians think this sounds really good, and it's really appealing because it's going to make everybody happier and make everybody feel better off. But is that going to be the real case? Now let's go back to bee and the honey company. Now, those jars of honey that bee makes have now become more expensive. The extra 30% on the minimum wage / living wage means that the labour costs of each jar are now £3.90 per jar, and the raw materials, so the jar they buy in and the honey that they buy in, has also gone up in price because they've got to pay increased labour costs as well. So that means it's now costing £2.60 per jar. When you add those together, the actual cost of making that honey is now £6.50 per jar. As you can see, it starts to become more expensive to make the honey. So what is the impact? Well, increasing the minimum / living wage by 30% is actually going to at least increase costs by the same amount, assuming that we always see an exact parity. Of course, the company may choose to actually try and make more profit and increase the selling price by a greater amount. That then poses a question, are you really better off? Well, possibly not, because disposable income is at least going to remain the same, because prices are probably going to increase by the same percent. Of course, that is what's known as cost plus inflation, when the cost increases and it pushes up the price for a product or service. You could actually technically be worse off because there's no guarantee that the company won't try and increase its prices by a greater percentage than that 30%. And this is why you have to be careful when you purely look at the figure of increasing the living or minimum wage by 30% on its own. Of course, in this example that I've used with you so far, we've only looked at the cost of production and not the selling price. It's fair to assume the selling price of the honey obviously would increase by that same percentage, otherwise bee would be making a smaller profit margin and potentially even a loss. But it doesn't just stop there. What about taxation? Is it actually a smart move for the government to actually increase the living / minimum wage? Because people could possibly end up paying more tax and actually end up with less disposable income than they had before. This all comes down to tax brackets, which determine the amount of tax that people pay. It also comes down to whether the government chooses to increase these brackets by the same percentage at what it changes the minimum / living wage by. If it doesn't do this, then it will actually reduce the disposable income levels. Let's take a look at an example. So currently in the UK, moving forward, the personal allowance, and that's the amount you can earn before you pay any income tax at all, is £11,500 per year. Then, on the next £33,500 that you earn, you would pay what's called the basic rate, 20% tax on that, before you pay the higher rate on anything between the £33,501 and £150,000, and that would be 40% tax at that rate. And if you're lucky enough to earn more than £150,000, you pay 45% tax on that. So you can see they're the brackets that are used. So if we take our example, before the actual increase in the minimum stroke living wage, B was earning £44,000 per year. Now, what we need to do there is work out how much tax B is going to pay. So firstly, we need to take away £11,500 from that £44,000 because that's B's personal allowance, which no tax is paid. On that remaining £32,500 that we've got, what we need to do then is find 20% of that, because that's what tax is. And that would give B the tax bill to pay the government in income tax of £6,500. So you can see there that B's tax bill to the government is £6,500. Now let's assume the government doesn't change its brackets of personal allowance or any income tax rates at all. So after the increase by 30%, B now actually earns £57,200. But how is B affected by the data that we see? Well, B would actually end up paying a greater amount because B obviously would deduct the personal allowance of £11,500, and then it would have to pay 20% on the £33,500 that B falls into that basic rate bracket. And then would also have to pay 40% on that remaining amount, which actually gives a total tax bill of £11,580 in income tax per year. What we start to see here is that actually B is paying more tax as a result of the change to increase the living wage. Now, yes, you might be thinking B's earning more money, but B actually has got less disposable income because we've established already that prices are most likely to increase by the same percentage anyway. So actually this is a way of the government taking off more tax and reducing B's disposable income. So what can we conclude? Does increasing the minimum stroke living wage make people better off? Well, it probably suggests probably not. And that's mainly due to cost plus inflation pushing up prices by at least the same amount of any increase in wages. Also, the government taxation brackets tend not to increase by the same amount. If they do increase, then obviously we neglect that point at all. But typically, the government may find that it will be a great chance to raise more taxation, why people don't realise what's happening. And of course, you're left with the fact that inflation tends to cause uncertainty, which means people tend to save and not spend, which of course has a greater knock-on effect on the overall economy. Of course, these are just some thoughts on what could happen, and there's no guarantee they will happen. But of course, it does show you how cost plus inflation could take hold in the UK if we see any increase in our living wage / minimum wage, and any impact that it could have on our economy. Thanks for checking out the BeeBusinessBee YouTube channel. Don't forget to click the subscribe button down below to subscribe to our YouTube channel. Don't forget to follow me on Twitter. It's at BeeBusinessBee. Also, give the Facebook page a like. It's facebook.com/BeeBusinessBee. And lastly, don't forget to check out the online hive of activities found on BeeBusinessBee.co.uk, full of quizzes, activities and resources. And remember, until next time, keep buzzing.